While the Prime Minister and his Finance Minister tout strong fiscal management and point to billions of dollars in new spending in the spring economic update, many Canadians are wondering how that macroeconomic plan will improve their daily lives in a climate of rising fuel and grocery costs. Those unpredictable factors are also creating challenging conditions for the Bank of Canada as it tries to set interest rate policy. Today, after factoring in all of those variables, including the war in the Middle East and U.S. trade policy, the central bank held its key lending rate steady at 2.25%. Here's the Governor of the Bank of Canada, Tiff Macklem, speaking just a few minutes ago.
We have three key messages today. First, Canada is being buffeted by global events and geopolitical uncertainties, but our economy is growing, and we expect it to continue to grow. Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices, combined with still elevated food price inflation, is squeezing more Canadians. And third, monetary policy is focused on ensuring that the jump in energy prices does not turn into persistent inflation, while helping the economy adjust to global headwinds. We are committed to keeping inflation low and stable over time.
And the CBC's business reporter Nisha Patel joins me again with more on this story. You were listening in along with me to the Governor of the Bank of Canada. What more did he have to say about making this decision to hold the key interest rate steady?
Yeah, the Bank of Canada holding its key interest rate steady at 2.25%, even as inflation in Canada hit 2.4% last month. That, of course, the war in the Middle East driving up oil prices and causing gas prices to spike. Still, the Bank of Canada says it's going to look through this energy price shock in the short term, though it does not want inflation to become widespread, and so it left the door open to interest rate hikes if inflation is to spiral out of control. The bank also laid out another scenario where if U.S. trade policies put Canadian growth at risk, then they could lower interest rates to boost the economy. So the Bank of Canada has kind of a balancing game to play when it comes to the risks to the Canadian economy. The bank does expect inflation to ramp up to 3% before coming down a little bit, but doesn't expect inflation in Canada to come down to target until next year. So for variable rate mortgage holders that were looking for a little bit of a lower cost of borrowing, they're out of luck, but they're likely doing a little bit better than anyone who's looking for a fixed rate mortgage right now. They are tied to bond rates, not the Bank of Canada's rates, and those costs have been going up, aren't they?
The Bank of Canada also updated its outlook for the economy. What's the latest on that? What's the forecast look like?
The bank expects Canada to grow at 1.2% in 2026 and says the Canadian economy is still facing a lot of uncertainty. Tariffs are weighing on exports and business investment. Canada and the U.S. are renegotiating a trade deal right now, and that is a big unknown for the Canadian economy if the U.S. imposes serious restrictions. Oil prices are also a wild card. How long will they stay elevated for? How high will they go? They're a bit of a mixed impact on Canada because, of course, higher oil prices mean higher profits for Canadian oil producers. They also mean higher tax revenues for Ottawa and for provincial governments. But when you have higher oil prices, it means higher gas prices. And that, of course, squeezes Canadians at the pump, and they have less to spend on the economy. So a lot of different factors at play for the Bank of Canada to consider. And it means that they have sort of a tricky needle to thread when it comes to how to manage interest rates.
No kidding. Thanks for this, Nisha. That is the CBC's business reporter, Nisha Patel.